Hi everyone, this is David and Parker with the Gellner Team of Kidder Mathews. We're here today to provide a May market update for retail investments in the Pacific Northwest.
Definitely, yeah. Thanks for having me as always. I think to start, we should address the biggest news, which is Rite Aid filing for bankruptcy.
Yes.
What are you seeing out there as a whole, and what should people be looking out for?
Yeah, so in case you haven't heard, Rite Aid about 5 days ago, as of the day we're recording this video, filed for their bankruptcy. Shortly thereafter, what came out is about 80 plus stores in Washington State and another 30 plus stores in Oregon that they're trying to have another party either take over those leases or potentially looking at closing those stores down in the future. So we've been in the thick of that, trying to help as many clients and ownership groups out as we can. I think the bigger items to kind of talk about is just one, the more, if you own one of these properties or they're a tenant in one of your properties, just getting out in front of it as much as possible, specifically meaning connecting with a retail leasing agent that specializes in medium box releasing is critical, because the timelines on these continue to be, anywhere from 6 to 12 months to get a tenant in tow and get the lease worked out. And so the more time on the front end that will allow for marketing and finding the best potential tenant, the better. What are you seeing? What are you hearing?
Yeah, I think to your point, we've been working on, I think now over a dozen of these, either connecting folks with leasing or giving ideas of both what it's worth vacant versus what it's going to cost to lease up. I think that's been a big question we've got, and maybe a surprise to some folks is to land, the premium tenant. It's going to be a premium TI allowance. So I think that's, there's, I wonder what you think, or, kind of tell everybody kind of the tranches of the likely backfills that we're seeing and the tranche of rental rate compared to how much that could cost in TI to land those.
Yeah, great point. And so, out on the outset of these conversations, I think a big learning point or awareness point right now is just the spread between these individual tenants and not only the rents that they could pay, but also, if you want the upper end of the rents, the TI allowances that are needed to get those premium rents, and they're ranging anywhere from $500,000 to $1 million pretty easily for the premium quality tenants. And then of course you can have other users. There's a few other users that would pay $10 to $15 a square foot and take a much lower TI allowance. But just want to make everyone aware that the TI allowances needed in order to backfill these are very large right now, just because of construction costs have gone upwards significantly the last 5 years. The other item that I think we should mention is that kind of puts us into the owner user segment is we have had a bunch of conversations and are listing a handful of not only for lease but for sale drugstore properties. The owner user demand that we're seeing is probably the strongest we've seen in 10 to 15 years pretty easily. Mm-hmm. Not just for these type of properties, but any other type of properties. And a lot of the feedback we're hearing from these purchasers or these buyers is that, with the cost of tenant improvements reaching such a level, a lot of them have decided it no longer makes sense for them to go sign a 5 or 10-year lease, put the money and the capital in for their tenant improvements, and then have uncertainty down the road, whether that be, renewals or just where rental rates will land. Because, the other feedback we're hearing outside of tenant improvement costs have been, hey, we've seen a lot of, in our leased locations, we've seen a lot of retail rental growth the last 5 years. And so, a lot of these buyers and tenants who are now buying their own properties are looking at it as a way to kind of stabilize their future. So the good news for a lot of the Rite Aid drugstore owners, if a sale is an option, that market and that demand is very strong right now.
Yeah, I agree. We're working on a couple right now that are going to be bought by owner users. One in particular, rents kept going up in their location. Landlord thought they could do better, and they're just saying, we're going to go out and buy and have that surety for 20, 30 years because the business is so successful. And especially a lot of the owner user buyers can't, most of them, I'd say 80% are grocers that have a wider net or a wider geography of their clientele. So they're less sensitive to be in that exact location versus within a 10-mile radius where people will still come to them. So, a lot of these, I think, potentially could be kind of the first mover or who gets the box up for sale first might land, those owner users.
Yeah, timing is critical. And if you are one of these owners, we would suggest, moving with urgency because we are expecting in at least our local Pacific Northwest market to see quite a few of these start to hit the market and become a competitive environment.
Yeah. What tenants are kind of the likely backfills? But I know you mentioned daycare, but what other tenants are out there looking for a 13 to 18,000 square foot box right now?
Yeah, so there's there's quite the spread in different tenants, but Dollar Tree, Harbor Freight, potentially Tractor Supply if the lot's big enough. Daycare operators, we've seen them start to repurpose some of these because assuming they can configure the outdoor playground on site in a good location.
We've seen redevelopments as well. So just if it's on a hard corner, great real estate, tenants will come in or the developer will come in and scrape it. We've seen car washes starting to figure out how they can convert the building into the car wash tunnel. So, use what's there, but configure it for a car wash, which has been really interesting.
Yeah, and I would add on top of that, there's a whole another tranche of tenants. If the building was able to be split up into multiple spaces, there's only so many tenants that go around that can backfill or are willing to backfill, like you said, a 12 to 18,000 square feet space. But if they're able to be separated, again, that's very costly. So just have to work out the analysis behind the scenes. But if, if the ownership does decide to split the building up into smaller spaces, there's going to be a lot of more tenant demand for that. Obviously, there's a cost, but the good news specifically with these drugstores is the overall majority of them are hard corner locations with a drive-through and a lot of good visibility on a main thoroughfare. So tenants are looking hard at these, and really the biggest sticking point we're seeing at this point is just the cost of tenant improvements and then the expected rental rates compared to what some of these Rite Aid, Bartels were paying.
I think, too, kind of how we've been working with various clients, depending on their goals, is, if it's unsure if you want to sell or lease or just want to see what's out there, we've been working hand in hand with our leasing experts to, once a lease comes in, we've got a really good idea of, hey, this is the tenant. Not all tenants are created equal in the cap rate world. On if they did want to sell, is it worth it to put the TI money in? Are you going to get that equity back, or does it make sense to just sell? But I think it's important to know, even if you land a tenant, what's your equity, what's your investment worth
Absolutely.
at the end of the day.
Absolutely.
And then another big news item, I think the vote's coming up in a couple weeks, but taxes changing. What are you seeing there?
The big beautiful bill, as it's called. So one thing that's important for retail owners or retail investors is bonus depreciation, accelerated depreciation is in that bill as of today. We'll see where it lands, but it is looking like, assuming the bill does get passed, 100% bonus depreciation is and will be back, which would be great news and really help kind of turbocharge the market specifically for automotive, gas, and those type of assets in the triple net world that really benefit from that 100% bonus depreciation. That's extremely attractive to folks, especially as, right now we're seeing a lot of ground lease triple net deals start to hit the market and get done, mainly again due to construction costs. So if you do own or are a developer building one of those assets that is obviously the building and land and then has that bonus depreciation aspect, we expect that to be very much in demand throughout 2025 heading into 2026. We have calls all the time, and specifically this year, from many groups who are just waiting for that to get solidified again because it is such a help on the real estate investing side.
Yeah, it's been, I know we talked about it, I think, last quarter on our update, where ground leases are becoming more prevalent with the cost of construction. And it's almost now like the push and pull again of people want to have the depreciation, but also there's the advantage of a ground lease just being completely hands off. But it'll be interesting. I don't fully know where it'll go, but it'll be interesting to see kind of the two sides of that coin.
Yeah, we'll definitely see where things land. Just to provide kind of an overarching market update as of May 2025. If we were to bracket, let's just talk about single tenant and then we'll move to multi-tenant. But single tenant specifically, and even for multi-tenant, we are seeing still a very price sensitive market, meaning for single tenant, $3 million and under, even 2.5 and under. The cap rates on those properties typically range anywhere from 5 to 5.5, obviously tenant dependent and lease term dependent, but the spread between a $3 million property and below versus a $3 million to $4 million or $5 million property, not only does the buyer pool shrink pretty considerably right now, but the cap rate expectations between those two buyer tranches and buyer pools is at least significant. And so that's something we've continued to talk about and continued to see. And with most of these new construction triple net properties that are hitting the market, we continue to see more and more ground lease properties because, again, the cost to develop the building as well, it's making a lot more sense for ownership and developer groups just to do a ground lease and let the tenant, spend their money and their cost into the developing of the building. So I don't know if that trend will continue. Right now, we're still seeing a huge surge of tenant demand for growth and new locations. And so as of right now, we do expect that to continue.
Yeah, I think we were talking about this before. We probably sound like a broken record on the price sensitivity and the tranches, but it's still been an issue. I know debt's been not stagnant, but I mean, kind of the new norm. And it's, anything where you're having to put debt on the property all of a sudden, or at least the buyer pool as a generality definitely has to put debt on the property. Cap rates rise significantly and there's more of a spread, and it's not kind of a even gradient, if you will.
Yeah, I think, and if we sound like a broken record, it's because it's exactly what we've been seeing for multiple years, at least in the Pacific Northwest, is because of how challenging it is to develop new product. We still have limited inventory, whether that's on the single tenant or multi-tenant side. So Washington, Oregon, Idaho, we've still been insulated from a lot of the cap rate expansion that other markets have seen. And so I think, moving forward, the other item to kind of mention is because of the Rite Aid bankruptcy and the difficulty in developing larger properties, that segment of, let's call it $4 to $8 million triple net, there's a really big gap right now in that marketplace just because the typical buyer pool for that would be looking at drugstore type properties historically. And those are, obviously that market's been rapidly changing. And so, I think it's going to be interesting to see how it unfolds. Multi-tenant, we should talk about. I mean, right now, again, on the price point side of things, $5 to $6 million and under multi-tenant, we're still seeing near peak pricing, believe it or not, from 2020. And it's solely due to two things, in our opinion. One is just the limited amount of multi-tenant inventory, especially shop space type properties, smaller shop space retail centers. That market is still very, very much in demand. And then the other thing outside of the low inventory amount is just the amount of new buyer pool that's coming into our segment, because of what's happening in multifamily with the recent rent control and insurance issues. Industrial seeing some softening. Office is obviously office right now. We've seen a lot of new buyer pool groups come into retail because fundamentally, with 3% or under 3% vacancy rates and rental growth for the last 5 years, it's been, if not the strongest, commercial real estate sectors.
Yeah, and kind of piggybacking on the multi-tenant demand and the smaller shop space, I just talked to a client yesterday who has a Rite Aid in the center. Big portion of the NOI is gone, and they were even thinking about this prior to Rite Aid, but they want to get into. They love the 2,000 square foot spaces because at any given time, Rite Aid 5 years ago was on top of the world. Walgreens was trading at $80 a share, and now they're seeing the benefit of if you lose a tenant, you can backfill it. You're kind of you've already underwritten for a vacancy factor, and nothing really changes. Where if you've got a big tenant, even the ones that we thought were really great 5-10 years ago, the future could be uncertain. So they're going to be divesting and looking for more, management intensive, for lack of a better word, shop space.
Absolutely. Yeah.
Overall, anything else anybody needs to be looking out for?
I don't think so. I think we're always here to help. If you have any questions on any of these items, please reach out anytime. And thanks for joining us.
Yeah, thank you.